On this first Tuesday of March, Governor Lowe and the Reserve Board met and they kept the cash rate on hold once again. But certainly what a difference a month makes when it comes to what's going to be happening in the economy moving forward and what's going to happen to the cash rate. And I want to talk more about what Bill Evans said in a minute in his predictions for 2 cash rate reductions over the course of 2019. But first we need to sort of understand what's going on. So, you know, the Reserve Governor and the board need to make sure that they bring some type of stability in terms of how they control monetary policy. And what they do is they can't move from a signalling of a tightening bias straight away to a signalling of a reduction bias or a bias towards lower rates. So they need to move slowly to that bias. And we saw that again in regards to the Reserve Board minutes and then in the monetary statement they released later in the month, signalling their intentions to potentially go to that neutral bias. Now that also meant that GDP, so gross domestic productivity, is going to be changed. Now they were forecasting in 2019 growth of around 3.25%. That has been adjusted down to only 3%, and we've also seen some further adjustments in the 2020 year. Now that has meant that through that signalling from that sort of tightening bias to a neutral bias to a reduction bias means that there's going to, or an easing bias means that we're going to be in a position where the cash rate's going to be challenged. Now, if any of you listened to our podcast, The Property Couch, you would have heard Dr. Andrew Wilson talk about he believes that the cash rate may change as early as April. Now we saw Bill Evans from Westpac, the Chief Economist of Westpac, talk about a potential rate cut in August and then another one in November. Now what's his reasoning behind that? I went and had a read of the statement that they released at the end of last month, and it was quite interesting reading. They were talking about the broader economic momentum in the economy and that broader economic momentum slowing down. So they moved from a 2.6% growth forecast in 2019 down to a 2.2% forecast for growth in 2019 and also 2020. So when they push that through their models, it also means that that's not sustainable for, you know, the long-term growth that we try to achieve, which is between 3 and 4%, and also to try and get inflation in between that 2 to 3% range. And we haven't been able to do that yet with low inflation. Now we did see some good numbers come out in February in regards to unemployment. So we saw the unemployment rate stay steady at 5%. We saw a greater participation, but to the surprise, we also saw 39,000 new full-time jobs get created. So that was a positive. But so we think unemployment in the near term is actually looking reasonable. We also saw the consumer sentiment index move back to a bias of positive outcome as opposed to a negative bias that we saw at the end of last year and in the January numbers. So there is a slight movement. It's only slightly marginally more optimistic than pessimistic, but it is a movement. So we needed to then understand what Bill Evans was trying to do and his team of economists there at Westpac. And what they were talking about inside the housing market were 3 main things. The first one was certainly a slowdown in construction. And that slowdown in constructions are going to obviously flow through to GDP and the number of the amount of money moving around the economy. So there was that. They also then started to look at the unemployment story, and they also started to look at the amount of credit that was being lent to both owner-occupiers and investors. And with that, they saw a double-digit decline in inquiry for loan approvals. And that also meant that in their models, they still thought that this year they would see sort of further price falls throughout 2019. So put all those numbers together, they've come up with a bias that there will be a need to ease the cash rate, 1, possibly twice. Now, what could be a catalyst for that not to occur? And us staying in a neutral bias. So there's still no evidence at all that we would see a tightening bias in the current situation, especially with what's happening globally with trade between the US and China and the mess in the UK with their Brexit strategy. So I think what we need to understand here is I think the Reserve Board won't need to move rates if a couple of things happen. So if APRA was to look at their policy settings around the assessment rates that they use for borrowers, and if they were to ease that off the 7.25% rate that they currently have the banks locked into and reduce that, say, by 50 basis points, that will allow borrowers back into the market. So we are talking not only about owner-occupied borrowers, but also those investment borrowers. That will stimulate a little bit more growth, but we don't obviously want to overdo it, so it's got to be cautious. Now, if they do that, the Reserve Board may not need to do anything, because we might see the property market stabilise more quickly than a lot of people anticipate. So most forecasters are saying that the property market will continue to decline in 2019 and maybe into 2020. Now, auction clearance rates for February were surprisingly better than what they were at the end of last year. They were terrible. Basically, buyers had abandoned the marketplace at the end of last year, but we are starting to see clearance rates in Melbourne and Sydney in some areas as high as 60, 65, 70%, but overall across the broader Melbourne and Sydney markets around that 55 to 60%. So if we see those clearance rates at that type of level, I suspect we won't see too many price falls further, and we've probably come out to the bottom. Now, if we do see some shocks in the system, such as a change of government and confidence in the business sector sort of starting to diminish, and that leading into the unemployment rate going further, and this is what Bill Evans and his team believe, that they believe that the unemployment rate could move back to as high as 5.5, really leaving the RBA no choice but to provide more stimulus into the economy by dropping the cash rate. So again, it's an interesting time. I can't see a cash rate reduction before the election. If one does occur, it means that the economy and the signalling in terms of all of the mechanisms that we're measuring, such as employment, such as GDP, such as inflation, such as wage growth occurring, that's not going to happen. Now, both parties coming up to the political election are going to be offering tax cuts. Those tax cuts could also be enough of a stimulus to get people out spending more. So very much a consumer story, very much a wealth effect story that we've been talking about over the last few months. So it is interesting times. I think you can certainly say with confidence that there'll be no more sort of movements in your mortgage rates over the course of the next 12 months. But if we do see the cash rate, hopefully we'll see those lenders passing it on to you, so that'll put a little bit more money in your back pocket. Thanks for watching, and I'll see you next month.